Wow, we got a good group today. So I'm very glad to be doing this again. Rounding up the year. This is our sixth boot camp, and it gets better and better for the people that are actually in our last boot camps. You guys are actually going to really like this one, especially around session 11 or 12. I've actually added two special sections that I had the Z-Man from our chat room help write about his intraday trading style and some different type of pullback plays and some swing trading patterns. And so we've taken our boot camp and rejiggered it to make it even better. I enlisted some help to fill in some missing spots that I really wanted to talk about. So I think that this one's going to be fantastic. Congratulations, for all you guys making an investment in this. Obviously, not just the financial aspect, which is, fairly considerable, but, also the time. I mean, this is a 16-day class, 12 review classes, simulator time. You guys are going to have to put up with me for a few months, but, I mean, frankly, we have a lot of people in here today that took our even first and second boot camp, so you kind of got to put up with me for what could be years later, Timmy. And so, that's a big investment. And so, congratulations on that. Trading is a profession, and so, the people that take these classes and do well, they realize, right, that you're making an investment into a profession for your learning, because this is no different than, being a lawyer or a doctor or an accountant. It's a trade or a profession, and just like those guys, whether you're an engineer or firefighter or anything, right, there's a certain, you have to go to school for that. There's a certain amount of training for that. There's the late nights and sleepless nights and studying, and it's just intense, right? You think about like people that are in med school and stuff. I mean, imagine all the pressures and hassle that those guys go through just before they ever commit surgery. And so what we're going to do is take, literally years of learning, because this would be no different than that, and try to condense it into really an all-intensive thing. And what I've done is use, my strategy, but also the ups and downs that I've had over the years, which have been considerable, and try to take all those years and condense it into a couple short months. But a lot of it's still going to be on you guys to really participate too, and make sure you come to class. If you don't come to class, right, these things are all recorded, but you got to, you got to participate, watch those classes. We've added 2 new chapters this boot camp. We've also added homework for the boot camp this time, so that we know that you guys are actually learning the material. And, we'll send out the homework to everybody on the weekends, and I will fully expect everybody to do it. And if you don't, I will fully call you out in front of everybody on Sunday, as it is the Sabbath, and we should all be open and honest about everything. And so I think that this is going to be a hot one, and I'm, as you can tell, I'm a little bit excited today, as I always am when a new class starts. But today especially, because I really like the new improvements that we've put in the boot camp class, and I hope you guys like it too. So for those of you guys that don't know me personally, I'm Kunal. I am the purveyor, is that a word? That sounds almost perverted. I am the purveyor of this awesome website called Bulls on Wall Street that I actually started building in 2007, and I launched it in 2008. I had 3 partners at that time who are not a part of this business. I've had some crazy ups and downs, hired and fired, and numerous employees. And finally, this past year, I really got the right mix of people around me. I hired my bozo buddies from high school, like Tim and the Butt Dog, and I have the new team around me that you guys will also have interaction with, like Mary Beth and Jordan and Ajit. All these guys actually at one time took my class. Mary Beth was my first student. Ajit is actually a kid who, when he was 17, he was in my chat room in 2008, and he was trying to learn how to trade. And, I coached him for a while, and then he ended up being an analyst at Citigroup doing banking. And after probably about 7 months ago, I ran back into him. I'm like, listen, man, I need you to come work for me. And he's like, listen, I'm 23 years old and making $120,000 at Citigroup. What are you going to offer me? And I'm like, well, I think I can offer you $200 a week. And he's like, for real? I'm like, yes, that is exactly where I'm going to start you at, because that's what everybody starts at. And he's like, yeah, blah, blah, you got to be kidding. And after the back and forth, I had convinced him that this $200 a week that I was going to pay him was going to be the best investment he ever made. And he quit his job. And, obviously that's what I started him off at, just to see kind of where his head was at. And then, now obviously he's making more money. But that's just how it goes. And then Jordan, who's our Mr. Fix-It guy, and if you guys ever have technical problems or problems logging on to anything, stuff like that, Jordan is the guy that fixes all that. He's also the person, along with Mary Beth, who helped me write these classes. Jordan took I'm all over the place. So Jordan took basically the 13 years of info that I have in my place, and we sat for months on Skype, and he just let me diarrhea mouth style, be like, and it was like one big tangent of this and that, and I ran him in circles, and somehow he took all that and organized it, and that's how we got our course book. And Mary Beth helped me make the outlines and stuff for that, and so it was pretty awesome. It was a team effort, and you guys actually have contact with these guys too. Usually Mary Beth will come in and do a class here or there. I know she's still got to do a class for our last boot camp people, as I like her to talk to everybody at least once. And, that's it, guys. I started this in 2008. I have had incredible success trading, and I've had some incredible downfalls trading. And I think that's really where my experience is going to help you guys. Because my first few years trading, the ages of 18, 19, 20, 21, and 22 were I would make huge profits for 3 months and then spend 2 days giving it all back and then be dead for 6 months. And then I'd go on a hot streak, almost like a gambler, like a blackjack player. I would go hot for 3 months, make all this money, and then I would give it all back. And, at first I just thought it was one of those things I'm a kid. Of course that happens, it's a learning thing. And then when I was 22, it was like, I'm not a kid. I just blew $50,000 in all the student loans that I just took out, even though my dad was actually paying cash for my college tuition. I took out student loans to basically gamble like a, big bozo. And, that was kind of like a little rock bottom moment. And from there, I decided, to really take this seriously like a profession. And I got very organized with my studying and my method, and I searched all over the place. I actually, I started off doing more investing, and then I did swing trading, then I did day trading, then I did momentum trading, growth investing, all sorts of I tried every aspect of trading. And what I did was I took, basically the bits and pieces that I liked on all of them, and then I adapted it to the kind of momentum trading that I think is the best for people that have smaller accounts. And by smaller accounts, I mean, people that are trading less than a couple 100,000, but even more geared towards the people that are trading 5,000, 10,000, 20,000. In my accounts, I keep 40,000 in my Ameritrade account. I keep 10,000 in my Lake Street account. I just opened an account with TM Global last week, and I put like 8,000 or 9,000 in that. And so, I don't trade with huge money, but I have great results because the style of trading that we're going to be doing is all about momentum and trends. And so we're literally going to be getting in stocks when they're about to move, and we ride them till, she bucks them. And, I think that the ups and downs that I've had over the years kind of really got me to that point. So let's start off. And guys, just a little housekeeping. This class will be recorded. Every day we will, by tomorrow at lunch, you will get an email in the Google group with links to watch the videos. It'll be on the Bulls on Wall Street website, and there'll be a password. And that link and password will be the same through, for forever, basically. We keep them open forever, all the boot camps classes. So, and everything we do in there will be put in there. Besides the 16-day class, which usually actually runs a day long now, and then we added an extra day, so it's going to be 18 days. Besides that, we usually do a couple extra webinars. One, on how to use like some of this software that we all that I teach on, and another one, that'll usually be like a surprise depending on what people want. Sometimes I have Mary Beth come and talk to everybody. It really just depends on where everybody's head's at. But all of those will be posted on the website, and you will get that link tomorrow, and it'll be up pretty much for as long as you guys want to keep watching them. I haven't taken any of them down yet out of the 6 that we've done. So let's get started to actual stocks. Enough of me rambling about myself. So technical analysis. Technical analysis is the style of trading that we do. It's the method, okay? And why is that? I believe that this method gives the small trader, the retail trader, the best shot at winning, okay? Beyond fundamental analysis and those type of things. And for really retail people that are holding shorter term things, and by short term I mean really anything less than even a month, a fundamental analysis just does not come, it does not move stocks short term. Yes, those fundamental analysis in terms of the fundamentals of a company, their price to earnings ratios, how much money they make, their management team, those things come about on a long-term basis. They impact companies on a long-term basis, a year, 1 year basis, a 2 year basis, right? But short-term, stocks move on just really a few different things. One is supply and demand. The other is sentiment. And, the other one is just momentum. And those can carry on stocks much farther and longer than what their fundamentals will say. And you guys will see it every day. How does a stock like a CBMX, how does it go from $2 to $9? No matter what happened on the stock in this news, at some point this thing will probably just come right back to $3, $4, but short term, it can just skyrocket because momentum and supply and demand come into play. Technical analysis, it catalogs market data and establishes a system for finding trade ideas, picking entries and exits, and most importantly, managing risk. It encompasses nearly all your trading decisions from steps A to Z. See, the stock market is just one big gigantic auction, right? It's a gigantic auction. And so, in the end, to have a stock trade, you need a buyer and a seller. And they have to come and meet somewhere in the middle, right? And so it's no different than any, auction that you would find in, freaking in the middle of India. You got a buyer, somebody that's on the bid, right? And he's saying, I want to buy this stock at 342. And you've got a seller, and the stock's at he's saying, what, I'm not willing to give up my shares until I'm 353, until you give me 353. And what will happen is, right, there'll be an interplay between these guys to see if they can meet somewhere. But there's numerous other people that also may want to buy that stock or sell that stock, and so they can jump in the middle. And so it becomes just one giant auction to see if two people, right, can make a match. And when you're dealing with just people who are, right, you're trying to make a match, essentially you're just governed by what? Supply and demand, right? How many shares are getting thrown out there versus, how many shares do people want to buy? And it literally can be that simple when you're talking about understanding how stocks move. See, technical analysis is not just about the price data that we're going to learn about, but it's really also about understanding the motivations of market participants and understanding those motivations and behaviors. They never change. They never change. And so what happens is things become predictable if you understand, right, how people are thinking and that people don't really change. I mean, if you think about it, in the 200 years, that markets have been open, nothing has really changed. The same type of things play out over and over. The same patterns play out over and over because people are the same, right? I mean, people are still governed by a fear, greed, right? I mean, there's all those emotions. Those don't change in people. And so what happens is their behavior becomes predictable because, well, what people were feeling 50 years ago when their stock was up or down or whatever, I mean, have human beings changed or evolved that much that all of a sudden they're thinking differently or their emotions are differently? No. And so what will happen is the same things play out over and over. And what we're going to learn with technical analysis is that there are spots in stocks. And what we use to, look at stocks is essentially this, right? Charts. We use charts. And what you'll find is the motivations and behaviors of market participants tend to be very similar around certain areas on a stock. And so what we're going to be doing is learning what these areas are so that, we can exploit, right, the price action that will come from it. As there'll be certain areas that can make stocks go up because of the supply and demand dynamics. And then there'll be certain areas that make stocks come down. So supply and demand dynamics of stocks, right? And, very basic stuff. When the demand for a stock exceeds supply, price goes up as buyers are forced to pay more to acquire shares, which is fairly simple, right? If there's only 2,000 shares available at, say, $3.53 on a stock, and there are 30, 40, 50,000 people starting to bid at 351, 352, so on and so forth, right? Sooner or later, people are going to realize that the next available supply might be at 355. They better snatch up at 353. And so that can make stocks just go dong dong, right? It can make them explode. When the supply of a stock exceeds the demand, price can go down, as sellers are forced to lower their price to sell shares. And what we'll be learning is that there will be places on charts when we're looking at these. There will be places that just induce supply. We don't have to get into the nitty-gritty of, right, how many shares are up for supply and how many are up for demand, right? We don't have to get that into it. But what we have to do is recognize that supply will come from a few different actions on a chart and a few different looks. And so once we understand where it's coming from, then we'll know how to avoid it, but most importantly, how, when a stock gets past that area, how we can buy it, right? Because now you've gotten past the supply zone. So we use charts. As technical analysis, we use these goofy things that we call charts, all right? And, when you look at a chart, I mean, this is a chart, right? When you look at a chart, it's really one of the craziest little pictures you're ever going to see. Because, you know, you throw this, like when I saw my first chart, nobody was even really into charting in 1999, 2000. I mean, nobody was. You couldn't find a technical analysis or analysister. Is that even a word? Analysisters, technical analysisters. Geez, ever, anywhere, right? There was just no such thing. But, you know, I mean, day traders are probably using it. But when I looked at something like this, it was just the craziest thing because it's like, what does this even say? It's just a bunch of squiggly lines. It's like, woohoo, like big deal, like stocks, you know, companies are more than this. And then, you know, once you realize it's like, well, for what we're doing, we don't need companies to be more than this. You know, to me, now companies are just tickers, right? GPRE is no different than NIHD. Unless it gives me a look that I like, then I love it, right? But in the end, it's just a ticker. I don't know or care what these companies do anymore. I want to know if it's got a look that I can exploit to make money, right? And that's, you know, and that's really the gist of it. So these charts look crazy because, you know, I at first was so into fundamental analysis. When I started off, I was into fundamental analysis. You know, I thought that Yahoo was going to, you know, rule the world, and that, you know, oh man, like Avaya Systems was going to be, you know, the next Microsoft, and I thought that Global Crossing was going to be the stock that made me a millionaire because they owned 6 billion miles of undersea cable, and the CEO was on CNBC saying this is the buy of the century, it's so undervalued. And literally like 3 days later, he was dumping all his shares as the stock price tanked, and I lost everything. But not because, you know, the stock even tanked, because I didn't know anything about trading. You know, most people, something tanks $1, they would sell, right? And when my stock tanked $1, I just bought more. And then when it tanked $2, I bought 3 times more. And when it tanked $4, you know, I bought 5 times more to try to get that average down. And before you know it, you know, you got nothing. So now, you know, I realize, right, you know, for what I'm doing, these charts are my friends. And the beauty of it is that charts, they don't lie. They don't lie because all it is it's just a bunch of numbers. See, charting allows us to see the actions of all traders in graphical format. All right? It allows us to see the actions of all traders in graphical format. So this graph is literally showing us what has happened in this stock, and whether you're looking at this stock, you know, what we're looking at here is like, right, a 6-month frame on this chart, right? So what we're looking at here is essentially every buy and sell decision that's happened in this stock cumulatively over the last so many months since June, okay? And so this stuff has already happened. And so there's really nothing to fudge, okay? And from this chart, we can derive certain data, right? Number one, these goofy little things we see here, they're called candlesticks. And the candlesticks explain price, all right? They explain price for that day. Easy enough, right? They explain price for that day. And so when you look at a candlestick, you're going to see a few different things, right? Number one, when you're on your platform, whatever you may use, you know, it'll say 33.47. So that's what the stock closed at. So when you have a green candle, essentially what it's saying is that the stock was up for the day. It opened, the bottom of the candle is where it opened, right? And the top of this bar in the box will be where it closed. And so you can see kind of where it came from and where it went that day, right? From open to close. So you can see kind of the action of the day. And then the tails, these tails are essentially where the tail goes up to is the high of the day. And if it has a bottom tail, then this is the low of the day. So like on this particular day, right, the stock went from right? 29 and some change. And the high of the day was essentially, right, 30, nearly 32 bucks. So, it had about $2 range from low to high. And the stock actually opened at, $30, and it closed at, 31 and some change dollars, right? So it's up slightly, and this is the high, this is the low. So we know the range of the day. We know what happened between open to close, right? So you got a little bit of story on that particular day. For the most part, now I'm not a huge candlestick guy. I, number one, just like them, is I think they look cooler than, what's it called, like bar charts and different types of ways that people show price on charts. I actually just think they look visually, they're easy for me to read. And, and then I can understand what was happening during the day between, who was in control. I mean, you see a stock, open here and it goes all the way down, then it spikes up. I know there was something going on that day. I can kind of feel the story of the stock. But that, that's about as much as I tend to use it. So on a chart, we find out the price of a stock via candlesticks. All right? Now, price is the most important chart feature. It comes before everything. And what we're going to be learning is essentially price patterns. Price patterns. And so we're going to really take this complex subject, and we're going to kind of stereotype it, right? We're going to make it easier by turning everything into a pattern-based system. And so price in its price pattern is the most important chart feature, okay? And we'll learn price patterns later on, but it's the most important chart feature, and it precedes everything. And so after that, we will start overlaying indicators on charts. But those indicators are secondary to the price pattern. Price rules over everything. Everything else is just used to confirm your price. Okay? And so when we use indicators, what you guys are going to see is that we use them to confirm the price. That's it. So they're confirming indicators used to add probability. So what does price show us? Well, price shows us if there's a discernible trend, right? Because we're trend traders. Ideally, we want to see if there's a trend somewhere, right? Whether it's in a shorter term time frame or a longer term time frame, whatever you may be trading, the price is going to show you if there's a trend, right? Is the stock going up? Is it going down within that trend? And that is huge because historically, the number one trap of new traders is to buy stocks going against the trend, right? Something looks cheap, so you buy it. Something is tanking, so you buy it, right? That is the quickest way, right, to get your nuts chopped off. I mean, literally, it's the quickest way to amount for losses. I mean, that's how I blew up with the global crashing. I only bought it at $5 because it came from $50. That was why I bought it. It looked cheap. And the CEO said it was a steal, and they got 6 billion miles of undersea cable. To this day, I don't even know what an undersea cable is, but I bought it because it looked cheap, and somebody said it looked cool, and I thought, boy, how much lower can it go? Yeah, well, it went, down to like 30 cents. That's how much lower it can go. So price shows us this discernible trend. For what we do, we don't want to be pissing in the wind, especially with our mouths open, because that is just nasty. But that's really what it is when you're trying to buy a stock that just keeps dumping without a trend. And so we want to stay away from that. So price is going to show us that. The price also shows us how a stock reacts around key levels on a chart. Right? How does the stock react around these key levels? And then, of course, the patterns, right? Which is really the most important thing for what we do. On a chart, after price, okay? After price, the most important thing on a chart is going to be volume. Fairly simple. The most important thing is going to be volume. You know, volume tells a whole story in itself. And after price, this is what we need to be looking at. Okay? So what do you get out of volume? All right? Well, number one, what is volume? Volume illustrates the number of shares that were traded in that specified period of time. So, like for instance, we here are looking at a daily chart. This is a daily chart. Each one of these candles represents one day. Okay? So price is per day. So each one of these volume bars indicates how much volume was in that stock that day, which essentially means the number of shares traded that day. How many shares were exchanged between all the buyers and sellers? Was it 1 million, 2 million, 3 million, 4 million, whatever, right? It's going to tell you that number. Now, it is for all time frames. So if you're looking and say you're doing, you know, some goofy type of day trading, then when you're looking at a chart, hold on, we'll get rid of that and go here. When you're looking at a chart, all right. So when you are looking at a chart, well, let's bring up like an Apple computer, right? So when you're looking at a chart, this is a daily chart. So the volume represents what was happening that day. And it goes for all time frames. So say you're doing like intraday trading, right? Well, intraday trading is you're trading within the day. So each one of these candles now, because I use 5-minute candles or 5-minute time frame on my intraday charts, each one of these candles represents the amount of volume that comes in a stock for 5 minutes, over the span of 5 minutes. So, you know, for example, at 12 o'clock, right, Apple Computers traded 400,000 shares in 5 minutes. Okay, so that's what volume tells you. The other things that volume tells you and things that we need to look at is, number one, liquidity. Liquidity in stocks is very, very important, because there will be times in a stock, if you are playing a low volume stock or a weird trading stock, what you'll find is they are very hard to get in and out of. And so we like to not trade those, essentially. I mean, that's the big thing. You know, you just don't, liquidity is, to me, the easiest way to describe it is, how easy is it to get in and out of the stock? Very simple, right? And so, like, say, like, you know, I've been watching GPRE forever. One of the reasons, you know, that I haven't taken the pass on it yet is that there's very little liquidity in the stock right now. You know, on Friday, it traded 88,000 shares. Well, the market is open 7 hours, right? Is this 7 hours? Whatever, 6, 7, 8 hours, something like that. And so if it trades 88,000 shares, right, let's just round it up and say, okay, that's 11,000 shares an hour. By the way, I am Indian, but I am not a mathematician, an engineer, a computer science guy. So you will see me doing weird, random math equations, trying to justify my argument, and the numbers will almost always be grossly wrong, because I just stink at math. That's why I became a day trader, so I'd never have to look at, you know, deal with numbers. Well, that, and, you know, because I'm unhireable, as who would want to hire, you know, some goofy kid who thinks he should be paid $1 million no matter what he does. That's besides the point. So say 11,000 shares an hour, right? 7 hours in a day. So say I have 2,000 shares of this stock. Well, it only trades 11,000 shares an hour. How easy is it going to be to get in and out of this stock? How, you know, to get a seller to buy up all my shares? You know, if I got in a pinch and I had to get out of this stock, right, I'd have to keep the bid probably even lower than whoever's bidding on it, because most likely he might not even want 2,000 shares. What if he just wants 200 shares? Then I got to go change my order and go down to 780 or 781, right, to get my fill, because I got to get out of the stock. And so that's a pain in the butt. And so we try to stay away from that type of action. Now, for me, what you'll find is, once you start getting even into the few 100,000 range, the liquidity becomes much easier, right? And once you're dealing, close to 1 million shares and stuff like that, it's much, much easier to get in and out of stocks right away. And so that's going to be big. Now, look, something like liquidity, I don't want you guys to put too much thought into it for the most part. We keep everything very simple. Make sure you focus your efforts. So liquidity, right, just remember, if it's very, very low volume, probably just stay away, because it's going to be hard to get in and out of. And when I mean low volume, right, you'll go through stocks and 1 million of them will look great, but then it'll be like, there's 13,000 shares a day traded, right? Well, that's pretty low volume. Stay away. That's really all you need to know. Once you get kind of, close to the 1 million, things become much more liquid on almost anything. Relative volume. Relative volume, to me, is really one of the keys on when stocks are going to move. It itself won't move stocks, but it's great as a confirming indicator of your trade. If you have an amazing price pattern, right? Price is number one. And you have strong relative volume, right? That is confirming your price pattern. Because what's relative volume mean? It means more than its average, right? In relative. So if a stock trades 1 million shares a day, but in the morning already when you're entering or looking at your stock, right, and the volume is already coming, and it's on a relative basis, like you're in the stock, right, and it's already got 1 million shares, say, traded in the morning, you've confirmed your trade because, right, it's already just the morning and it's already had its daily average in volume. Sometimes those thin stocks, how we know they're going to go is if when they have a great pattern, and then all of the sudden, say it trades 200,000 shares a day, in the first hour of trading, right, it's up at 400,000 shares. Well, 400,000 shares of volume is not a lot of volume, but it is a lot of volume on a relative basis for that particular stock. And so that's important. It's confirming what your price pattern is telling you. It's like, yay, my eyes were correct. There was a pattern there. Other people saw it. People are interested. It's coming in. It's go time. Accumulation and distribution patterns. I think that this is very, very big, okay? Accumulation and distribution patterns. What does accumulation essentially mean? Now, once again, I'm not a classically trained stock scientist, so everything I say is going to be for our own method, okay? For me, accumulation is essentially, right, when in a stock, it's getting accumulated long term or over a course of period of time where the buyers are in control. So what you end up seeing is on the up days of a stock, when the stock is going up for the day, you will see more volume than on the days it goes down where you'll see less volume. So essentially what that means is, right, the stock is going down, but there's very little volume, which means there's probably very little selling. So often it could just be, let's say, right, some profit taking. It could just be a few people saying, hey, I had some fun in it, I'm done. And so there's nothing fundamentally wrong or technically wrong with that stock. It's just, right, it's pulling back in its natural progression of its trend, okay? And that's big. Distribution patterns is now going to be like when you start seeing big on its down days, right? You see big red bars on the volume and the big volume bars, and then on its up days, the green days, you see very little volume. So what would that tell you? I mean, that's common sense, right? When the stock is going down, people sell it like crazy. And when the stock is going up, right, there's very few buying. And usually what that means when it's a distribution pattern, and it will happen in stocks that are like really hot stocks that people know about, like an Apple, or, you know, there's like some new thing and everybody's into it, like a Groupon or something. Everybody's into it. And so the stock is pulling back, there's all this selling, and then it has a green day, it's up for the day, and it might be up even 3 or 4%, but there's very little buying. But people get excited because it's like, hey, it's up 3%, this must be the turn. But then you look at the volume and you realize, what is it? What is that? Why is there such little volume? Most likely it's because there's just retail buyers who know the name, who realize it was cheap, and so they bought some, right? But retail buyers don't bring in any major volume. They're not going to buy 1 million shares at a time, 100,000 shares at a time. The average retail buyer is going to buy 500 shares, right? 200 shares. I got one guy in my chat room, some kid, he's like 16. He buys like 30 shares of everything, you know? And so, right, that's the sucker's bounce. And what happens is when that stock bounces, because it's in distribution and the people in the know, the smart money, are selling that thing, when that stock bounces a little bit, all of a sudden, more shares get rained down because now they got a better price to sell. And all of a sudden, you will see those institutions and whoever, big traders, just rain down shares on that poor little guy who's buying 30 shares at a time, saying, bam, suckers bounce, right? And so how to stay out of that is by learning accumulation and distribution patterns. The other thing is when a stock is pulling back, right, a lot of people view that as a negative. But like for me, if a stock is in accumulation and it's pulling back within its trend, to me, that's a buy. Because often if it's an accumulation, it is just pulling back as a sign of profit taking. Let me see if I probably got some stocks I'm even looking at like that. Hold on. Hold, stop, wait a minute. Ain't number tutti fruity. Get on float, you got that booty. You guys remember that song? Who sang that? Salt-N-Pepa? Oh, you know. Sorry, I had a coffee today, and I'm all hyped up again. Let me find a good pullback play for you guys. Dun, 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 dun. Dun, dun, dun. Dun, dun, dun. Dun, 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 dun. Oh, so like say something like this. We entered this stock on Friday, guys, right? Was it 14.45, something like that? So the stock had a huge, huge run up here, right? I mean, the stock went from $10 to $15 without a rest. See that? Green candle, green candle, green candle, green candle. I mean, that's pretty impressive, right? So you could it's safe to say the stock is kind of moving. And so within the trend, because it didn't pull back much, see how it just pulled back here? 3 candles. But look at the selling on this, right? There's not much selling here, right? It's just an easy-go-lucky pullback within its trend. Most likely it's taking a rest or making a profit, you know, it's some profit taking. And so that is the type of pullback that I can buy because it's still in accumulation, right? And so this is a stock that actually held into the weekend because of one of the specific reasons. One was price pattern, which is this would be called a flag pattern, which we'll learn later. And the other thing is, right, it's just pulling back in a normal manner. And so that's, you know, it's still in accumulation. Oh, yeah. Whole HOV. So, guys, HOV was up 7% on Friday. We bought HOV in our chat room at $5.11. We literally sold it like 6 minutes later for $5.31. One of the reasons that, you know, I was okay with buying HOV was, you know, when it pulled back here, you know, it wasn't very heavy selling like its previous pullback. You know, it seemed normal. And so to me, that stock was still in accumulation. So it was a buyable pullback. See this DXCM? See how it popped up here the last few days? Right? So it's made these moves the last few days on some decent volume here. And then see how it's pulling back, right? At one day pullback here, right? Much less volume. One of the reasons it's pulled back is it's so overbought, which we're going to learn in a hot second, and it's very extended, right? Another very light pullback compared to its big up days, right? So this is not a distribution type of pullback, right? And so that's something to me that would say, hey, you know, I might be interested in that type of pullback. Right, RGN, see how these red bars are lower than the green bars when it was going up, right? So to me, that's a low volume pullback. Soda, right? Less volume selling on the pullback. And so to me, that's still a bullish thing. So fairly simple. So that's an accumulation and distribution pattern. When stock is in accumulation, buyers are in control. What people will do, especially traders, is if they know the buyers are in control, right, they will also jump in knowing that, right, they have a high probability chance that the stock is going to stay within its trend. The next thing we put on these bad boys, moving averages. When you're looking at this chart, you see some squiggly diggly lines, right? Squiggly diggly lines, all right? What the heck do all these squiggly diggly lines do? Like, what do all these things do? I mean, they don't really mean anything. I mean, they're just lines, but they serve some special functions on charts, all right? So a moving average is simply, for all purposes, for us, is just some squiggly lines on a chart. What they do, each moving average, and there's three types that we use, all right? A 20-day moving average, a 50-day moving average, a 200-day moving average, all right? A 20-day, 50-day, 200-day. So what a 20-day moving average is it's just a simple computation of the average price of the stock for the last 20 days. And a 50-day moving average is just a simple computation of, you know, the average closing price of the stock for the last 50 days. Now, the 200-day is the same thing. You know, why it's that, I don't know. Never even thought about it. But that's how they're computed, all right? And so what that does, right, if you have the average closing price, say, of the last 20 days, you know, when you're looking at a stock, sometimes it's all over the place, right? Like if you're looking at, say, this soda or something, right? It's all over the place, okay? And so at times it's very hard to discern if there's a trend or if there's anything. You know what I mean? It's very hard because you're looking at the price and it's confusing because you're like, well, boy, that's like a hot mess of a stock. Like it's all over the place. I don't know if it can go up or down or whatever. And actually, the more I look at this, I don't even know if I like this chart anymore. But it's a hot mess. So how do you discern if the stock is on a trend in a particular time frame? How do you figure that out if the stock is all over the place, right? Well, we can use these moving averages, okay? The moving averages serve two purposes. Number one, to help identify trends, right? If you look at a stock, sometimes if it's a hot mess or it's just a little confusing or you know what, your eye is not prepared to figure out if that stock is trending or not trending, you can overlay these moving averages. Well, we're going to overlay moving averages on everything, but you overlay them, okay? And that's going to help you identify a trend on some specific time frames. Number one is a 20-day moving average, right? That equals short-term trend. 20-day moving average, short-term trend. 50-day moving average equals the intermediate term trend. And the 200-day moving average signifies the long-term trend. Fairly easy, right? Fairly easy. So 20, 50, 200 SMA, wham, bam, thank you, ma'am. That's going to help you identify the trend. So how do you know by looking at the moving average if it's a trend or not? Very easy, by the slope. Just by the slope, right? If the slope of the 20-day moving average is up, right, then the short-term trend is up. If the 20-day moving average or the 50-day moving average is pointing up, then, right, the intermediate term trend is up. So like say this GPRE, what do we have here? Well, we have the 50-day moving average trending up, right? We have the 20-day moving average was trending up, and now it's kind of flattening out. And then we have the 200-day moving average, which is still in downtrend, as this stock was, 18 bucks, a handful of, 2 years ago, right? And so that's, you can tell on a longer term basis, right, that this stock is probably not necessarily an investment in terms of, because it's still in a downtrend, right? And so it'd be a little bit tricky. But intermediate and short term, we can look at the stock and derive, well, there is a potential chance for this stock to have a trade in it because, right, at least short term and intermediate term, we are in an uptrend, right? And we can just look and see, right? Whoop, whoop, right? We can discern that. Oh, guys, and you know what? Probably a lot of you guys don't have any charting platforms yet. While you're following along with me, use a website called freestockcharts.com. It's free. It actually is made by Warden, which is what I'm using here. It's going to look exactly like what I have on mine that I pay for, but you're not going to have to pay anything. It's pretty cool. Search for company. How do I sign in here? Hold on. Oh, I think I am signed in. So I don't know why this thing has been cut off here on the side, but that's beyond the thing. Apple, right? So you can make your charts look exactly like mine. All right. Just a short tutorial for this. Right. If you want to add your moving average, just do add indicator, moving average. You add it, then you add it to price history. All right. So now you got a moving average here, and then you can edit it to period whatever. So if you want a 200 or a 20 or a 32. Whatever it wants. And we want simple moving averages, right? So whatever. So, we use 20, 50, and 200. So overlay them on, all right? Then the second thing you want to do is add volume, right? Right, so now you got volume on the bottom. And then the last thing you want to do is add your stochastics on the stock. Stochastics. How do you spell that? Oh yeah, somebody's just correcting me. I'm even saying stochastics wrong. So stochastics, and you keep the period of 5. You keep the numbers 533. All right, and so if you do that, you will have a chart that looks like mine. Easy enough. Freestockcharts.com. Sign in. It's pretty much close to live. You can use them during the day. They're great for at night, and they're going to look just like mine, and so that's the most important thing. It's actually a very cool tool. You can make watch lists and draw lines on stuff, and it's got a lot of features here. You can make scans and have portfolios. I've got like a random gold portfolio, and just stuff in there, and add symbols. Play with it. They got some great videos on YouTube on how to use it and better and stuff like that too. You can also set alerts on stocks, which is very important, so you don't forget about them. So you set alerts, and you can actually do it like You can do it kind of like Facebook and make friends with people and stuff. And now you got a friend here, and you can see what he's doing, and it's pretty cool. Freestockcharts.com. Get it if you don't have a charting platform, and we'll talk more about software and stuff later. I think for now that will really suffice, especially for those of you that are not trading yet, which I do recommend. You know, if you've been trading and you've been having losses, right, and that could be one of the reasons you're here, well, give me a chance to, right, help correct those and take a few weeks off trading, take a month off trading, get your head right, and get your learn on, and then go back to trading, or work with me on finding a date when you should go back to trading, because everybody's different. But I find personally, just from talking to so many people, and you know, we've had 100 and something people take this boot camp, if you are not a good trader and you're taking this class and you're trading, what will typically happen is, right, you're going to go through the day, you probably make some losses, it's going to piss you off, and then your head's not going to be in the right spot to take the class and right, get everything out of it, because you're not going to be in that winning mentality. And so why even stick yourself in that situation? Just get off the trading. It'll probably save you money, and then work with me on a time where we can determine if you're ready to trade, because there's a few simple things we can do to figure out, right, if you know the material, and then number two, the psychology part of it, on whether right, your brain is functioning in a way that is conducive to trading, which, you know, is obviously a little bit subjective, because I'm probably a nutcase and here I am trading. So, right, that part we'll have to figure out. All right, so moving averages serve two purposes. Obviously the trends. And the number two is it acts as areas of support and resistance. So what the heck is support and resistance, right? Support and resistance, and we're going to go into a much deeper detail in another section, but support and resistance are just essentially areas where demand can come into a stock, aka support, or supply can come into a stock and it holds it back, like resistance. Essentially, stock is going up, right, and it starts fading because it's at resistance. It's a supply zone. A stock is pulling back, but it bounces because that's an area where demand comes in. That's what support and resistance is all about. And there's multiple ways to judge support and resistance and find out about them. But the easiest way and the simplest way is via your moving averages. Okay? And if you look, I mean, you know, even on some of the stocks that I'm picking, notice what I'm doing here, right? I'm finding stocks that are actually resting on support, on the ones that are pulling back. See that? How they break and they're pulling back to these moving areas. These are the stocks on my watch list. See that? 20-day moving average. See that? Pulling back. So it's very simple. I mean, these are areas that hold up a stock. See the stock? I mean, went right into highs here, right? This is its highs. This is its high, and this is probably where every goofball would think they got to buy. But, you know, for me, what I'm interested in is this, right? It's pulled back to this layer of support here, and the support is held. And, you know, so that's something, I'm not buying this stock, guys, you know, but this is something I'm interested in. This is something I'm watching. You know, look at that. VHC, right? What has it done? Right? It's been going nicely here, then pulled back, then had another little bounce. Now it's pulled back, right? And I'm hoping that it can bounce again. So it's going to be a stock that I'm watching again. Holy moly, why is this thing not moving? Right? YGE. Right? Another stock that had this huge move, right? And then look, right? It's consolidating here right along an area of support. And so why is that important? Well, support is called support because it holds the stock up, right? So to me, that's an important area because it's an area that makes trades and stocks low risk for me. It lowers my risk because everything that we do is going to be centered around managing risk. If I teach you anything, it is going to be how to be an amazing risk manager. I'll tell you what, for one thing, I'm not probably the best trader in the world in terms of making millions of dollars and huge $10,000 days. That's not really my style. But one of the things you will notice about me is I very rarely have bad days. Like a lot of times when you have bad days in the chat room, it's like I made $200 or $300, and because I kept my losses really short, so when I screwed up on a stock, right, I had great risk on it, and so when I'm even blowing up trades, it's like we lose a few $100 that day. It's like no big deal. The reason I can do that is I'm always looking for stocks that are near a line in the sand. And essentially what I mean by a line in the sand is a support can often serve as a line in the sand for you on a stock. Because if you are buying a stock and it's near support and it breaks support, should you be in the trade? Think about that. If we're looking at this stock, right? And I'm looking at it, or any one of these stocks, doesn't matter. Like this stock, right? So I'm looking at this stock. And one of the reasons I like it is it's pulled back to support here, okay? Now, if it breaks this zone here, is my trade of me watching this stock, is it even valid? Like if I was in this, if it got down to here, would my trade be valid? No. How could it be valid if one of the thesis for me wanting to own the stock was that it should bounce off support? Because support is where demand comes in. Obviously, if the demand didn't come in at the level of support, then my thesis is wrong. And right, so that means I shouldn't be in the trade. So that's your line in the sand. The line in the sand is where the stock goes when it goes against you. Your thesis becomes incorrect. And so now you know you cannot be in the stock unless you're a crazy person or you're just breaking the rules or, you just screwed up. It could be a lot of things, right? But we don't want to be in it. That's the thing that I'm going to be teaching you. Sure, we're going to learn how to trade. But the number one thing is you shouldn't be taking big losses because we're always going to be looking for the sweet spot in stocks where a stock can go, but more importantly, where we can get out. Because that's the thing that really kills people, right? I mean, how many times have you looked at your career or your career in stocks or, your trading in general and just said, you know what? If I just did not have those 5 horrible trades, my results would have been okay this year or last month or last week. It would have been fine. But, I got a little carried away and I had these 5 trades or 3 trades that were just terrible. And, I lost so much money on those. It's like I'd have to make 100 good trades just to make it back. And so that's what we're going to be really learning is, it's so important to know when to enter a stock, but the most important thing is really finding stocks we can enter that give us an easy exit. And so support is one way that we can monitor that. And we'll learn many ways, but that is the one and the most easiest way to monitor that, right? So areas of support and resistance. And you also see that, stocks, tend to sometimes, right? These moving averages can also serve as areas of resistance, right? Where a stock can start rolling over. It just can't, see how it can't get over this area? It's like tap, tap, or it's too much resistance. And right, and this is a stock, I used to have on my short list for a while, and actually kind of looks like a decent short again at some point if the market rolls over. But see how this resistance, it just can't get past it, right? And so it's serving as an area supply. Stochastics, all right? Stochastics is this crazy little line on the bottom of our stock here that reads 533. So it's Stochastics 533. This is a very simple tool, all right? This is a very simple tool. This will tell you if a stock is overbought and oversold, all right? When you have a 20 Stochastics, that equals an oversold condition. When you have an 80 Stochastics, that equals an overbought condition. Fairly simple. So why does that matter? Okay, what you will find is when stocks get very overbought, just like in anything in life, right? When everybody wants it, it's probably not a good deal. Does that make sense? And like a 20 equals oversold, right? And a lot of times, like, wait, nobody wants it, it can be a good deal. In essence, you know, we're going to be using it like that, but we're going to be overlaying our trends and things like that, okay? Now, guys, all these different things we're learning, like moving average, stochastics, price, volume, none of them are to be taken individually, all right? None of them are to be taken individually. None of them mean anything just on their own besides price. All of these things are confirming indicators, and so we take them all in together, right, to build a case for the stock, a reason to buy it or a reason to sell it. You know, it's no different than, you know, if you're a lawyer, right, and you're building a case against somebody, right, you have to have pieces of evidence to convict somebody guilty, right, and it has to be beyond a reasonable doubt. And a stock is the same thing. To me, I always think of stocks as guilty till proven innocent, right? And it's like, you know, we really got to prove beyond a reasonable doubt that this is a trade that we need to be in. And so a trade is just a 50-50 shot, right? On any given moment, right, there's a buyer and seller. You meet somewhere in the middle. Somebody wins, somebody loses, buy, sell, right? There's a winner and a loser. It's just a 50-50 shot, right? A zero-sum game. And what these indicators and the things that we are learning and overlaying together, each one of these things is going to help build a case to take that stock from a 50-50 shot, the coin flip, and build a high probability case, right? To go for the conviction. Build a high probability case. And so we start with the price pattern. That's probably the most important thing. And so the stock is just 50-50, right? You know, you can buy it, it can go up, or you buy it and it goes down, but you don't really know, right? It's just a guess. But then you have an amazing price pattern, price action involved in this stock. And now that price pattern, right, is powerful. So it takes that stock and all of a sudden you've got something that's like a 65% shot of it moving on its own because of the price pattern and where you're buying it to be smack dab, right on the dot, right? And then what's going to happen is, right, you're going to look at your moving averages and your support areas. And you're going to say, man, I've got a line in the sand on this stock. I've got an area that's holding this stock up as I'm buying it in an area of demand. Well, guess what? You just added in some more probability. Ching, ching. All right? Now, you've got your stochastics, right? You've got your stochastics. And, right, the stock was overbought for a long time and it was cooked, and now it's pulled back to that area, and now it's oversold, right? Now you added some more probability to the thing, right? Cha-ching, right? The pattern of the volume is in accumulation. So now you have this stock. It's got a great pattern. It's pulled back to support where you can get out. It's got a great volume pattern, right? A great volume pattern that says it's in accumulation and probably will get bought on the dip because the dip was just due to profit taking. Bam, 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 right? Add in the stochastics, boom, now you're making it rain, right? You've got all these different things. And maybe one adds a little bit of probability, another one adds a little bit of probability. Before you know it, You built the case, you're going in for the kill, you're putting some money behind it, and next thing you know, you're driving Ferraris. The only thing is you got to do it probably like 10, 15,000 times correctly before you get to that point. But, right, brick by brick, that's one good trade, all right? We use the 5-3-3 settings for stochastics. Remember that, 5-3-3. If you are going to plan, and see, right now I'm starting everybody off trading like me. As we go through this class, what we will find from all talking together is going to be that there will be some people that just don't want to do short-term trading. And I've already talked to some people that are coming into class, they want to do more swing trading, right? Where you're holding stocks for a week or 2 weeks, right? And so, you know, day trading is just, they own companies. You know, we have one gentleman in here, he's just like an amazing businessman, and he's got an advertising agency and a bar, and, you know, he's, you know, had car businesses and all sorts of things, right? There's a good shot he's probably not going to sit there and buy a stock and sell it like 13 seconds later like I would if I had too many cups of coffee, right? He's going to be probably looking for more explosive gains. He's going to be looking for the 20% gains or the 30% gains, something more elongated, right? So for those type of people, you don't have, you know, then we'll probably use 14-3-3 stochastics. That'll get you the overbought, oversold conditions a little bit elongated. The first number stands for the period, right? So I use a 5 period because in reality, you guys don't really see me trading stocks longer than 5 days, right? In and out, 1 day, 2 days. And so we want to get our overbought, oversold indicators quicker. Where somebody is going to be more of a swing trader, right, and hold stocks for a week or two, then a 14-3-3 stochastic makes more sense because that's right almost nearly 3 business weeks. It's 14 business days. But for now, all intents and purposes, we'll all use 5-3-3, and it'll make things a little bit easier. So, stochastics. One of the cool things about stochastics is it can add probability on certain plays. So, like one of the reasons I liked Argent wasn't necessarily that, you know, everything was great, but sure, it went on this monster run, right, from $5 to $7. What is that? $2 on a $5 stock. That's, you know, solid 50% move. I don't know, 40% move, 30%. Let's say 33% move. We'll go in the middle of 25 and 55. Yeah. We'll go in the middle of 25, 55. Let's say it's a 33% move. Right, so now it's pulled back 20%, okay? And so that's great. And it's resting near a moving average. So, right, I've got a line in the sand. The volume pattern, right? Not as much selling as it was on the last up days. Good. And then see this? Stochastics oversold, right? Stochastics oversold. I mean, its last bounce started, it was on support. See that? Its last bounce started when it was on support, and the stochastics were low, right? And even the previous run in July, right? Stochastics at under 20, right? That started one of its runs. And so it's, you know, I've lined up different things, right? I've built a potential case on this stock, all right, on a pullback type of play. And so that gets me to say, hey, I'm going to watch this stock tomorrow, see how it acts. Maybe I'll take a trade in it. You know, we're going to find out. And even if you're looking, right, if you're looking at the market or commodities or a lot of different things, what you'll find is that even the markets themselves react very, very well, right, to overbought and oversold indicators. See that? Right, when we started our bounce here in November, vastly oversold. Right, we pulled up to here. We had a, you know, we've had a pullback here to work off what? Overbought condition. You know, overbought, right? When we had the bounce here from here, we were oversold. That was one of the catalysts. It's not the only catalyst, guys, but it is a catalyst, right? June, oversold. Middle of June, right? Overbought, you get a 5-day pullback. Get a pullback, get oversold, you get a bounce, you get overbought, right? You pull back, you get oversold, you get a bounce, you get overbought, so you pull back, you get oversold, you get a bounce, so on and so forth, right? It's not the only thing that impacts the stock, but it is part of it, right? A part of it. And the main thing that you have to know is, right, think about something. If something is very, very overbought, what are the odds that it just keeps going up? How many times, and I really challenge you guys, you will see it. You'll see stocks stay overbought for a week or two. Every blue moon, there's a special stock that just defies gravity, okay? Those stocks are very rare. And we are not into finding, right, the $1 million once-in-a-lifetime trade. We're going to play probabilities for everything. So I challenge you to really do some homework and say, go through like a list of like 500 stocks, right? And find how many times a stock stays up and keeps going up after it's triggered an overbought condition. Like, in how many days can it go up, right? You'll find that the amount of days it can go up after it's been overbought is somewhat limited, right? Yeah, it could go up the next day and the day after, possibly, but the probabilities are against it. More than likely, right, when you trigger an overbought condition, a stock could go up, but the probabilities are that it's too far, too fast, a little bit cooked, and it's got to come back down. Will it be to the T? Not always, but it's just common sense, right? Something's gone straight up. You've triggered an overbought condition. What are the odds that it could just keep going up, right? And vice versa if it's triggered oversold, right? Sure, it could go down another day. But what it tells you is to say, like how I use it, I don't use it as the signal to buy and sell, but it's a part of what I do to build a case. But it also says, hey, Canal, I think that we should start looking more closely at this because it's triggered an oversold condition, and the probabilities tell me that a bounce is coming in it, whether it's today, tomorrow, or whatever. The probabilities are starting to favor a bounce versus it keep going down. And as a man of probabilities, that's all I'm interested in. I want to put the cards in my favor, right? From just taking this thing that we do from a gambling type of profession or gambling type of thing that we do during the day to something that is based on mathematics and probabilities so that the stars are aligned in our favor when we make a trade so that more often than not we can make money. Will we make money on every trade? No. But if you can make money on 6 out of 10 trades and your gains are bigger than your losses, you've made a very significant income. If your gains are 2 times bigger than if your gains are twice as big on the days you're winning versus the days you're losing, right? You've made yourself a nice income on 6 out of 10 trades. And guys, look at a lot of charts. I mean, you got to do a little bit of homework here, and really prove it to yourself that some of this stuff actually has meaning. Bollinger Bands. Now, Bollinger Bands are just a real simple thing. It's a band plotted 2 standard deviations away from the 20 DMA, which is something you don't really even need to concern yourself with what they are. But essentially, what it is, it's an envelope around a stock. Oh yeah, add indicator. Bollinger Bands. Shoot out. Oh, yeah. There we go. Bollinger Bands 2010. So a Bollinger Band is just an envelope around a stock. It's basically the envelope in which a stock should be trading, based on its own volatility and mathematical whatever, right? the one thing you should know is that stocks will tend to travel within its band. And what you'll see is that when you start to break out of its band, it signifies an area where you can potentially get a reversal. All right? When it starts to break the band, what that tells you is that this stock has gotten a little bit too stretched. And like a rubber band, right, it's got to snap back the other way. You've pulled it too far, and so now it's got to snap. Okay? And so it gives you a sign of a potential, right, reversal or potential going the other way. And you'll see how stocks react to them. Very rarely do you see a stock just completely stay out of its band, right? You know, very rarely. And they can often signify, you know, potential spots for reversals, as they act as almost like a support level, right? Our recent bounce in Apple after it came down, basically just got murdered, right? It was, you know, coming down, right? The bottom here was its bounce. And it had a multitude of factors that contributed to it. Number one, right, you know, we were in a price support area, as you can see here, right? We're in a zone of price support. Number two, right, you snap below the lower Bollinger Band, you're oversold. Now, it had been oversold for quite a few weeks, but you're starting to reach a case. And then we take the price pattern where it had a reversal candle here indicating a rubber band snapback play, and that's where you get the bounce. And the Bollinger Band can be one of those tools that we can use. I see the market here, right? When we finally pierce through it, that's where you can get the bounce. And vice versa. When we pierce above, it can signify potential areas where it can snap back. Right? And now, once again, does that mean every time something pierces the Bollinger Band, the market reverses? No, of course not. You'll find certain times, you know, it might drift out, but what you got to do is remember to overlay everything, right? You're building a case, and it's not just one thing that matters, but everything in conjunction with each other. Now, when you're building the case, will everything align all at once? No. Like, for example, if everything to me aligned, and say the stochastics were not oversold and I'm looking to buy a stock, that's not going to really matter so much, right? The key is, you know, say I'm looking to buy a stock and it's not overbought. Well, to me, that's still good then. At least it's not overbought, right? So I know it's not going to turn back around, but everything else looks good. Great. So now I've got a lot of things aligned, but maybe the stochastics are just neutral, right? Maybe the Bollinger Band is, you know, maybe the stock's in the middle of the Bollinger Band, right? So it doesn't indicate it's going to snap back either way. Maybe it's just in the middle of the Bollinger Band, right? To me, that's neutral, right? And depending on which way I want to go in the stock, as long as it's not getting in my way, then neutral can be good. And so, and this is going to take practice, guys. We're going to have to look at, you know, hundreds of stocks together, maybe even 1,000 stocks to really get the hang of things, but this is part of it. So Bollinger Bands can indicate areas of potential reversal. Just keep an eye on those. There's something that people don't really talk about. I actually don't even overlay them on my day-to-day charts. I kind of have a feeling of when and where the Bollinger Bands will be at this point. As you know, like today I flipped through probably 2,000 charts to make my list. You know, I could have run some simple scans and probably looked through 300 charts, but I'm a junkie for charts, and I take this little laptop everywhere I go. So I could be sitting at the bar, you know, watching the Lions get their butt kicked in. You know, I'll have my little charting program. I'll be flipping through stocks, you know, just space bar and everything, like, whoa, and so I flip through a lot of stocks. And I do that, you know, on a daily basis, not always 2,000, but, you know, minimum 500, but most likely even closer to a 1,000 sometimes. And you guys won't have to do that. I'll teach you a shortcut on that. I like to know everything. So I've literally, over 13 years, if you think about, you know, 200 business days in a year, you look at an average of 1,000 charts, right? It's safe to say I've had 1 million reps of looking at charts in my brain, and so I can make a snap judgment in things. We have to get you to that point, and so just bear with me when some of these things look confusing, because it will be, because when you're trying to build a case for something, right, there'll be some conflicting signals at times, and we're going to have to work through that and make sure you know, that we're looking at the right things. But I hope you guys got the gist of it. That is it for today, guys. This was a primer. This sets up everything else that we're going to do, right? This is a primer. It sets up every single thing that we're going to do. But, you know, this in itself is probably going to keep you out of a lot of trouble. I'll tell you that. Because think about this. For all the mistakes you made, you know, when I've looked back at some of the stocks that I've really blown up on, a lot of times is because I bought a stock way too high without a plan. You know, it was piercing out the upper Bollinger Band, and it was overbought. And, you know, I'm buying it at the top essentially, and then boom, it snaps back out of nowhere. And people are like, why did it snap back? I don't. And, you know, the first question people always ask me is they go, do you see any news in this stock? Why is it down? Like, a stock can only be down when there's news out. And we see this in the chat room. Some of these guys, they know, like Doug Nastrom and Tim, they see all the time, they'll always ask, like, why is the stock down? And it's like, stock doesn't have to be down just because there's news out. I mean, it literally could just be something so simple as, right, it's gone up too far, too fast on a technical level, and it's got to come back down. You know, and rest, right? It's got to reshape itself. And that can only, you know, a chart can reshape itself in a matter of just a day or two. You know, in a day or two, you can work off the overbought stochastics, the Bollinger Band, and, you know, next thing you know, things are looking much cozier. But these type of things will keep you out of trouble, right? You don't want to be buying something like this, right? After stock's been up 20 days in a row, breaks out of the upper Bollinger Band, and it was overbought. Is that a best way to buy? No. But guess what? When it pulls back to that 20-day moving average and it's oversold, that could be a good spot to buy. So, right, that's right in itself. You've got yourself something there. Let's open this bad boy up to some questions. I hope you guys like this. And guys, you know, always give me feedback. Give me feedback, whether it's good or bad. If it's bad, try not to shame me right before trading, because I'm overly sensitive and I'll take it the wrong way, at least right before trading, because I get all hyped up before trading, and it's like, for me, because I'm a nerd and I'm Indian and I have no athletic ability at all besides being ridiculously handsome, every day when I go to trade, it's like my Super Bowl. You know, it's like, hey, you know, me against the men. And so if you got criticism, just don't do it around 9:15 and 9:25, because that's when I'm having my coffee and I'm already all getting hyper. And I'm very sensitive because I'm about to trade. It's like sending a man out, you know, for battle, but not a real man, just a, you know, a desk nerd out to battle. You know, that's our battle, Dungeons and Dragons style. This is like Dungeons and Dragons. So, questions. Boom, 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 boom. Oh yeah, let's go. Hold on. Let me open this question box up a little bit bigger. Ryan Sini, Ryan Sini, you are a pervert. Okay, Key Wester. So when you do solid green candles versus empty green candles, essentially, when you're looking at the candles, like, you know, oftentimes what it will do is give you, when you look at a candle, right, oftentimes it's going to give you the, you know, it's going to tell you, number one, if it's up for the day, but then it's also going to tell you, right, where it opened versus where it closed, okay? Now, if you've got a solid green candle instead of an empty one, what that's going to say is it's still up for the day, but it may have closed lower than it opened, but it's still higher than its previous close. And so it's up for the day, but the stock itself, you know, intraday, right, it didn't close higher than, you know, where it opened, right? So it's like during the day, the sellers took over in the stock, but it's still higher than its previous day. Alex Trujillo. Alex, my man. Hey, did you get my email, man? I'm going to put something together for you. I promise, I swear on my life, I will put together that swing trading webinar for you. And I've actually absconded some help for me to do it. I just got to get organized, man. I'm all over the place. Alex's question is, do you monitor stochastics intraday? Alex, I do not. Alex, I will say that stochastics and Bollinger Bands actually do kind of work intraday also. For me, I can't find, I just don't like to bias myself sometimes. It's just too much information for me. I know like the Z-Man uses, but see, he uses a lot of freaking indicators. He uses stochastics and MACD and all this stuff. And what you're going to find is there is a law of diminishing returns on stocks. And so kind of, when you get to that point where you got too many damn indicators, you really, really, you're really, really pushing it. So let me see. But I would say the one thing you could do, right, is there's different levels of stochastics, but, if you're curious about them, it doesn't hurt to test them out. You know what I mean? Test it out and see if it works for you. See if it works for you. Add some things to it. And before you know it, right, you're gonna have an idea like, hey, is this gonna bounce? Does it work? The stocks dip when the stochastics get overbought, and do they bounce when they get, when they dip? Oof, that was a nice one. So that'll give you kind of an idea of, whether you should use it or not. I find during intraday, I just don't want to get too many signals because, we're looking at more of the large. We'd like to try to get some of these larger term breakouts, but they can work. I just don't use them. Hey, Mark Brummett, how you doing, brother? Mark, so VWAP, and we will go over it on the intraday chart, which is like day 8 or 9. But let me give you a quick snapshot of it, of what it does, so that you can at least start monitoring it. Okay, so a VWAP is essentially, to me, it stands for volume weighted average price. So think about that, volume weighted average price. So it takes the average price of the stock over, divided by basically all its volume, right? So it's like, you get an idea of what the average person paid for that stock, essentially, right? And so intraday, I like to use it a lot because when a stock is under its VWAP, right, essentially the majority of the people are underwater, right? The average person's underwater. And so to me that says, right, the stock will probably be under some selling pressure, where when it's over the VWAP, right, I tend to find that the dips get bought in the stock as people are in the money and there's demand that comes into the stock. I treat it basically like a moving average. And one of the things I do is I treat it like a moving average. I actually use it to buy bounce plays and also to short stocks. I use it a lot to short stocks when a stock breaks below it. And so it can actually act as support and resistance. Hey, Paul Washa, how are you, sweetheart? Paul Washa's asking, what is my computer setup like? How many monitor screens do you use? Paul Washa, for the last 4 days, I am just trading on this laptop. And, I've got a Samsung Series 9 laptop, but for the most part, I don't use very much. I've got a Hewlett-Packard here, like for my desktop. When I am at home, I travel a good chunk of the year. But when I'm at home, I do use a desktop because, I'm standing up all day and, it's just easier to see stuff. So I've got a Hewlett-Packard, I've got a Hewlett-Packard desktop. It's like an HP, I believe they're called HP Pavilion. And I got it for You guys are gonna think I'm so cheap, but I actually traded off a netbook, a 13-inch netbook for years because I didn't want to be tied down. And one of my subscribers, his name is Graham Natlin, and they're a super rich family. They had an IPO in a stock called NetTeller like years ago in 2000, and I made like $100 million. And so, he would sit around all day and trade with me because, he's already half retired. He's like only in his 30s. And so what ended up happening was, he one day when he found out that I only trade off a laptop, and one of the reasons was I was just being cheap. I didn't feel like buying a desktop. He actually sent me like a Best Buy certificate for $500 after I gave him a good trade. And so I bought this HP Pavilion years ago with that. And then, all I've done since then is probably added some RAM to it. I think total price that I put in this computer is like $500. And, it's worked magically for like 2.5 years or so. And it's pretty cool. The other thing that I have is a 27-inch Samsung monitor. Let's see. I got a 27-inch Samsung, and they're not very expensive. I got it on sale for, which one is it? I got it on sale for like $299. So it's not, like a big fancy one. But I find 27 is just gigantic for a monitor. It's pretty cool because then I don't have to keep up like 1,000 million things on it. I probably have, I think I even got all mine refurbished. And so I got it for like 200 and something bucks. It's pretty actually cool, man. I didn't realize having such a big monitor would be so helpful. A lot of these guys use like, I've seen people buy like, $1,000 monitors and stuff like that. I'm all about saving money, man. I'm all about saving money. And so, you can get a great Samsung monitor for a few $100. And I just got one. And then what I do during the day is I'll keep my laptop next to me, and I keep my laptop to the left side. I'll put a picture and stick it in the Google group. I keep a laptop to my side of my keyboard during the day, and that's where you'll see me like when we're in the chat room. I'm on video, so that laptop I'll be on video, and you'll see often like a side profile of me. That's when I'm going off my laptop. And then I use that laptop for like Gmail and Facebook in. Like if I'm bored, I'm Facebook in. Sometimes I'm Mats.com in, whatever. But I'm using that for kind of like just my miscellaneous, just goofing around stuff. Like during the day, sending emails like, hey, what are you doing? Blah, blah, blah. And that's it. I don't have 2 monitors would help. I've actually had a second 27-inch monitor that I found on some deal site that I got for like $199, and it's been actually collecting dust in a box for about 6 months because I've been too lazy to connect it because I get so confused by all the cords. So that's it, and then I got my iPhone for a backup, and then I got this BlackBerry Bold for a backup after that, and I got this 2005 Toshiba that I use as like a super backup in case my laptop goes down, and that's it. Oh, and then I've got this sweet new thing. When I'm traveling, I just have my Samsung. I got a Samsung Series 9 Ultrabook, which is just like a thin, like 2-pound laptop. It's pretty sick. It's the first time I actually spent money on a computer that was, because I was going to Florida and I didn't really want to run out. And I connect this, actually the second, I got this for $100. There's like a USB monitor. And so when I'm on the laptop, I just connect this USB monitor. And so then I can have this second monitor, and I keep my Gmail and my Pandora and all that stuff on that. And then I just use my laptop for trading. And it's more than enough, at least for me. So I hope that answers your question. You don't really need much. And we can go in further on that stuff if you need. Let me look, Ryan. CIE, potential rubber band snapback. Yeah, I would say so. Yeah. I mean, I was trying to short this the other day on this snapback here. So, yeah, of course. Tim, I did get your email. Sorry, man, I was just preparing for class and stuff. I'll get to it. Ryan, how to get trades so quick? You know how you get trades so quick, Ryan? I'll tell you the number one way is to use your own trades instead of following somebody else's, because then, right, you're not being reactive, you're being proactive. And one of the things, like people like, say, Dr. Tim's in this class, and we got a lot of people in this class, they don't necessarily take any of my trades. Like if you see Dr. Tim, he's been in this boot camp now. This is he's in my first boot camp. So this is his sixth boot camp. He's come in and he's made a good amount of money the last few months, and he keeps coming in. But he uses like my watch list and stuff, and he uses that as a guide, and he knows like where my trigger points would be. Like if I like to buy stocks of support or certain types of stocks, I like to buy a breakout. And so he's trading along with me instead of waiting for me to, tell him what to trade. But, he still might use my ideas, but he might get in it earlier, or he might get in it after, because he's got his own style now. He knows how to do this. And so he's not just sitting there waiting for me to tell him when to sell and tell him when to buy. He's got his own plan on the stock. Ryan, well, what do you mean? Of course, I mean, I don't have like a, yeah, this thing here is my screen. This is what I use. This is where I would put my watch list. Every day, whatever stocks I'm watching, I just stick it right here. And so this is what I'm watching all day. And I'll set alerts on the stuff and do what I got to do, but it's nothing intense. Stick them on a watch list and you're good. James Andrews, email Tim. James, I've had my firm ID, I think, penciled in my thing forever, but I just got a new iPhone, so I don't know if I have mine penciled in. James, email Tim, tim@bulloson.ws. He will get you the firm ID for the iPhone app. Oh, yeah, James, we do. Dash Trader does have hotkeys and stuff. I think they call them, they don't, shortcuts, hotkeys, all the same thing. If you go here, help videos, I've got a list of Dash Trader help videos here, and then we actually did a Dash Trader webinar that Peter the intern did. Let me see. Oh, here it is. Dash Trader webinar, and it went for like 36 minutes, and he talks a lot about shortcuts too, and or hotkeys, I should say. And we've got actually 3 or 4 webinars that we've done. I can do a new one too. If there's anybody using Dash that wants a webinar, I will get one set up so quick. Before you can even say quick, I'll do it. And so then we have this too. I just basically put all the YouTube videos. Dash Trader has his own YouTube channel. Saving and loading charts. Market view, right? They've got, I put all the YouTube videos on this, so they'll be on there. You can just go on YouTube. Oh, Gina, I'm so sorry, sweetheart. You know what? I have not properly informed you of a lot of things. All right, so if you go on bullsonwallstreet.com, we'll have a blog. We have a blog, and let me see, Dash Trader, do boot camp, watch this. Oh yeah, Trading Boot Camp schedule. And I can email this. Actually, let me email this to you guys right now, so that shoot. Oh shoot, where did it go? Hold on one sec. I am so bad with these computers. Oh, yeah. What do you do? Oh, yeah, you just hit Gmail. Sorry. Dun, 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 dun. 16 day. All right. And you know what? We're going to email this to Tim and tell him to do it in the Google group because I don't think I've been added yet. Oh, that was not it. Sorry, guys. I am really bad at computers, so you just got to bear with me. What you'll find is in the beginning, it's going to be really annoying, and then at the end, it's going to be endearing. Gosh, I hope so, at least. I think Tim forgot to add me to the Google group. That's why. Best friend, my ass. Alrighty. Hold on. Where are those questions? But it's right on there, Gina. Sorry about that. AJ, how you doing, brother? Is there a price range for the stocks you trade? AJ, there is not. What you will find is you won't see me really go above $100 stocks much. But it's not because I'm against $100 stocks. I just don't find any of them often moving with the explosion that I like. You know, there's just not as many $100 stocks as there are, right? $1 to $100 stocks. I mean, there's thousands of stocks between 1 to 100, but there's only a handful of them that are above 100. James, you can set up alerts in TC2000. You can set up audio and email alerts. And in TC2000, you can even draw like a trend line and then put an alert on that trend line, my brother. Let me show you real quick how to do that. All right, so say I'm looking at LNG. Oh, sorry. Drawing tools. And you can draw it and say it's just, whatever. That's your hypothetically set alert, right? Price history crosses this trend line. Notify me. Blah 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 blah. You can have it, emailed. Oh, look at Mary Beth trying to use my TC2000. Sneaky girl. Gong sounds more fun, doesn't it? No, that's a bad gong. Yeah, it sounds like a good alert. All right, and so you just put in your email. It'll do a sound. It will do a email, and you're good to go. Ryan, you're right. I mean, we will trade $100 stocks. See, Baidu we traded last week a couple times. But right, Baidu was moving in the way that we wanted to, so we took the trade. And we were shorting it. You know when you short stocks, bet on them going down, it can be a $200 stock and it will drop like a bag of crap if it breaks support. All stocks really can, when it's time to go down, stocks can go down much faster than I find that they go up. That's why I love shorting so much. They just happen so quick. Anybody else? Terrence, my man. Everybody in my chat room can attest to this. Terrence's question is, can you just trade the first few hours of the day and make money? Reason asking is he's from the other side of the world. Terrence, I believe, is from Singapore. If I remember, I had a conversation with him in August, and he had mentioned Singapore. You can, and all the guys in the chat room will tell you this about me. It's like I make 75% of my money the first hour of the day. Then I spend the next 4 hours of the day giving some of it back. And then the last hour of the day, I make whatever I lost back or add a little bit more. But the first hour and the last hour of the day I find the most important, but by far the first hour or two in the morning is where all the action is. That's where you see all the stocks spike. And what typically happens with stocks is they spike up in the morning right at the open, and then they go sideways for a good chunk of the day. And then towards the end of the day, they start making runs again. But you can totally trade just in the morning. And I imagine if I am ever lucky enough to find a good woman to marry me and give me child, I probably will just trade the first couple hours of the day too, as I will be a house daddy. Ryan, let me look. CHTP. You know, this was a news play, so you got to be very careful with this. I can't even spell word shit. Sorry, guys. I've been watching my swearing, and if you guys noticed, that was actually the first time I swore, and I only said the S word, which is actually not bad for me. I'm more prone to say the things that make my mama very embarrassed about me being her child. So, yeah, Ryan, I think there's probably a snapback. You know, when a stock has bad news, people just start dumping it because, you know, they're on margin and shit like that. And, damn, I said it again. So, you know, I would watch for a potential snapback. You just got to be careful, man. These type of stocks, I mean, this thing could go to zero. You know, you never know with these stocks. So it looks like this is a support zone, you know, I guess right here. And it's then, you know, but then the next zone is here. So you're going to have to watch this carefully. This is not an easy trade, bro. It's not an easy trade. This is a flat out stock's been nailed. Yes, it's probably due for a dead cat bounce. Question is, you know, are any of us skillful enough and more aware enough to catch it? It's going to be a tricky one, but we should watch it. Gina, you could probably trade during your lunch break, but I find lunch action stinks for now. But Gina, once again, you don't have to be a day trader. See, I actually, yeah, I didn't put this in part of my story, but after college, my parents being Indian and wanting me to be a doctor, MBA, or an engineer, my dad kept telling me, be an engineer, you can make $70,000 a year for the rest of your life. He's like, man, you can even own a house someday. And, you know, that was his mantra for me. And so after college and my blowing of the student loans, I actually had to get a legitimate job. And I was in the recruiting business. And so I actually did swing trades where I would hold stocks for like, you know, 2 days, 3 days, 4 days at a time, 5 days. And you could still, I mean, just the returns are just the same as day trading, you know, depending on your skill level. You won't lose any money from not being on day trade, but doing more. You can have 2 or 3 or 4 swing trades going at a time where you set your stop loss and you know, have a plan for it just the same. So it doesn't matter if you're just trying to trade during your lunch break or whatever. You can actually go and do swing trades, right? Look for stocks that you can hold for multiple days, and we'll go through that. Oh, yeah, Steve, iPads are great. They have a great go-to-meeting app for on iPads. Ryan Samila, so since TC2000 can be delayed when trading starts to use your DAS platform. Ryan, I will put actually, I sprinkle my alerts depending because, you know, DAS sometimes can be slow, but then I actually put my alerts in this. DAS I sometimes do, but my bigger watch list is in this because DAS I don't find I can watch this many stocks in DAS. You can watch, I always keep my DAS Trader watch list because I use it strictly for day trading. I keep my DAS Trader stock watch list with like the 10 hottest stocks of the day that are going to be good for day trading, and I just keep those in my DAS. And so those, since they're intraday, you know, I don't need to have the alerts on them. I use the ones for my scans at night. Just put them on this, and that works well for me. And I also use TC2000. TC2000, what I actually like to do, though, is, you know, I want my alert to come like a couple percent before the actual, trigger. So, you know, you gotta, kind of use a little bit of your own, you know, however you are. And for the most part, I don't even need to set alerts because I'm sitting at the computer all day, which is going to be a little bit different for you. I also have like this note function, and you can do that in TC2000. So like literally you can stick in there, you know, like a note saying, hey, buy on cross, you know, buy over 10, you know, and you can set a note in there, and then all of a sudden, you know, you can put alert, and coupled with your note and an alert, now you're going to have plenty of a reminder. But try to set the alert before the actual trigger price so you can actually bring up the stock. Ryan, if you're trading through DAS, so you set your alerts in DAS, And you know what? If you find that you're not organized enough to catch them, then set them in DAS and also set them in TC2000 so that you get emailed. I don't know about you, but I always keep my email up. So for me, it's easy to be like, hey, watch this stock, and you get an email. Bill's saying, when you're looking at your quick trader watch list, what are you focused on in the morning or price? Bill, most of the time it's like just kind of like the hot movers of the day, which are going to be really the stocks that are up the most that day, that have volume, that are, that we're watching. So it'll be like kind of the momentum stocks of the day, and, I'll filter out the crappy ones with like 30, 40,000 shares a day in volume and make sure it's something that's, that's tradable. And Bill, like a good time to do that is, you can do it. I mean, I like to look for the gappers in the morning before the market opens to see like what's already moving pre-market. And I actually post that, in our chat room and stuff too. The other thing is, I do a quick run through at lunch to see what was the hot movers of the morning, and you can just use you can use a top gainer list or something like that, and add those on your list, right? There'll be probably only 4 or 5 that you really need to watch, after lunchtime. Say, oh man, this thing could be setting up for later. Anybody else got a question for me? That's it, guys? You guys are weak today. No, I'm just kidding, man. 2 hours, not bad. 2 hours in and out. All right, well, going once. Going twice. Sold. I will see you guys all Tuesday. Guys, Google group invitations. Email Tim if you did not get it or cannot find it, and we will get that taken care of. And guys, do me a favor. Introduce yourselves in the Google group. Hey, my name is Mark Brummett. I'm an Aries. I live in Canada. I like long walks on the beach and the Notebook and buying flowers for people on Tuesdays. I'm looking to do this, and my goals are this. And hello, everybody. Welcome. I have been reading a lot of Match.com profiles. I really got to find myself a girlfriend. I can't be locked up in this room again. Mark, I'm just messing. You were the last person to ask the question, so I just said that. Oh yeah, Paul Thompson, how you doing, brother? Paul's asking, do you have scanning tools to help you shortlist interesting or hot stocks? Paul, I do. I use this tool right here, TC2000. This is where I do my scanning. Costs like $30 a month. We will actually, Paul, as this class goes on, we will do a full session on how to use this TC2000 because they do have a free trial, and I'm actually working on the guy over there to give my guys a discount, try to get for like $19.99 or something if we bring in X amount of people. And TC2000 is really cool. You can run your scans. I will give you all my scans after we do the scanning webinar, and I'll also show you some free ways to do them. But, I've got different scans that I've wrote over the course of the year. Some of them are very simple, 4% breakout scan, et cetera, et cetera. And, so I can use this. Now, the one thing I'll say is, scanning, people focus a lot on scanning. Scanning is about 1% of trading. See, the funny thing is new guys, people always focus on the scanning, but they don't yet know how to trade the stock. So the scanning has become pointless. The scanning is pointless till you get to that point. So I can help you out the scanning and even help you out to use this. But let's try to go in order, and you know, we have a specific day for scanning and things of that nature, because I got to get the basics in for you guys first. And so just give me some time to get through the material, and I will show you how to scan. I promise. Tawan, my man, thank you. All right, guys. Well, if that is it, then I will see you all today. I really thank you guys for hanging out with me and letting me go off on odd tangents. I always feel awkward when I feel myself doing it. I got to reel myself back in, but you guys put up with it pretty good. See you all Tuesday. Rock and roll. Have a great week.